I think the CEOs are doing the same thing that fund managers are doing and investors are doing, is they're probably taking a step back and saying, well, how certain do we want to be about guidance? So you're seeing a lot of things about widening the band of guidance. You're seeing people lower expectations so as to not surprise the market. But you're also seeing a lot of uncertainty, particularly out of China. Things have slowed very appreciably there. And those numbers are somewhat perplexing and in some cases slowed faster than the financial crisis. And so from that point of view, that uncertainty, we suspect, will take at least a quarter or two to resolve itself. And part of that's cloaked in trade, but part of that was actually happening well before trade happened anyway. Yeah, they're obviously much better than they were 3 months ago or 6 months ago. So from that point of view, you've got these so relative, we're an absolute return manager, so we're trying to find share prices that go up. Relative return managers are trying to beat an index. And so what you see is that they'll crowd into defensive type stocks during these periods and away from potential growth type stocks. And so what we find interesting right now is you can buy Amazon on a lower EBITDA multiple than you can pay for Coke. Now, one I would argue is potentially a consumer staple of the future, and one's a consumer staple potentially of the past. One's growing its revenue at 2%. The other one's growing its earnings at revenue at over 20%. Facebook's actually trading even below all the consumer staples, yet it just reported a 30% revenue growth number. So there are some really good opportunities throwing themselves up here in what we would call companies of the future that I think most people are across now, but are ultimately getting really quite cheap versus other companies in the world.